All right, welcome everyone. I've not been doing too many videos recently, but there are some good reasons that I'm going to talk to you about in just a second. I'm also going to talk about the markets, which is why I decided to jump on, because I don't know if you've been watching what's been happening in the markets recently, but over the last month or so, things have looked really good, and a few tech stocks specifically had a big up month. I mean, it is after having a big sell-off earlier this year. For a few months we've not been doing particularly well, but we're now in a situation where some of these tech stocks are now beginning to actually climb back out. I've actually been, just in case anyone's interested, I've actually redone my whole studio. You'll notice that the camera, it looks slightly different. I look a little bit closer, and I've got a bunch of new gear and new kit, so I've been upgrading that. I actually also took a few days off, which is why I wasn't actually around making videos. And some of the videos that you've noticed me putting out recently, I pre-recorded and put them out because I just had to take a few days off. So now we're back. Now we're going to be going pretty hard from now on. So expect a lot of content and a few videos a day, probably back on that train over the next few weeks. Anyway, let's talk about the markets. Let's talk about the markets because some interesting stuff's been happening, and I'm going to learn my new gear as I go, and I'm going to be continuing adding to it. But anyway, let's first quickly look at just what's happening. So let me shove myself in here. So this is my stake portfolio. We're going to come to this in a second. I just had my a little bit of money turn up. And we're going to go and buy some stuff in just a second. But first, let's talk about some of the companies that I'm invested in. Anyway, let's look at Tesla. Tesla today has been taking a dump. Actually, before we dive into the details, a bunch of tech companies been diving, and in particular, two of the ones that I have quite a lot of money invested in, which is Tesla and CCIV. They've been taking a dive for two slightly different reasons. So Tesla have just announced their new model Plaid, but there's been a few disgruntled kind of things coming out because Elon is continuing to play the whole game with tweeting. So Bitcoin has just shot up because he's begun tweeting that as soon as some of the big Chinese miners are going to go green, then suddenly Tesla will begin using it, because at that point it'll all be good and dandy. I don't really see the argument as being in any way valid, because presumably, so what they're doing is they're basically going to switch some of these farms that are currently the majority of Bitcoin mining in the world to use green energy, predominantly in China. But as part of that, it doesn't really improve the overall impact of Bitcoin. Just because those farms are going to go and plug into renewable sources in a moderate way, it still kind of means that other people who would have used that green energy will now have to go and use coal instead. So it's not like they've gone and built a whole load of solar farms or built some massive new wind farms or something like that. It's just sort of a pretend play. Anyway. The one thing that happened with Tesla, aside from some of the small things to do with China, to do with policy, is they went and cancelled the longer range Plaid Plus or whatever they were going to call it. And now we're sort of left in a position where the model that people were really thinking was going to go and take the luxury vehicle, the premium vehicle by storm, by having a 500 plus mile range, the one that everyone was kind of saying was going to be the flagship, that's not now happening. It may be happening. Hello, by the way, everybody who's joining. Thank you very much for joining. That's not now happening, and that has sent the stock kind of falling alongside a few other smaller bits of news, because people kind of expected something to begin happening, because people know that in Q2 there's been some issues with the Chinese factory. There's issues with China not wanting their vehicles to be exported. There are pressures on the internal Chinese market, where figures for April reportedly, this is not official, but reportedly were much lower than expectations. I think they said they were sort of in a 20-something thousand sales, which is below where they really needed them to be to hit their Q2 targets. But anyway, the Berlin news, because that factory continues to be changed and modified, they're now saying that they're going to be producing more batteries in there. They're going to repurpose and redevelop some of the insides of that factory. That requires more approvals by German authorities, and German authority approvals take an incredibly long time to actually turn up. And so as a result, there's question marks as to whether there's going to be a delay on that. I actually I was very surprised that they were saying they're going to begin producing cars in that factory this year. I probably expecting that to happen in Q1, Q2 next year. But anyway, Tesla is now down. We're down to $605, which is pretty good. Let's have a look at what's happening here. What are we? Yeah. So sort of a continual downward trend all the way through the day so far. And are we going to be seeing below $600? Well, we shall have to find out. By the way, if anyone has any comments as to how this looks or anything, because I'm for the first time filming with a bunch of new gear. I actually can't even see my camera because I now have a teleprompter type thing, gadget thing. I can't even see the camera. Let me know in the comments. I'll be grateful. Anyway, CCIV is an interesting one. So CCIV is the SPAC that is acquiring with Lucid Motors, and anyone invested in this SPAC is going to be a joint shareholder, sharing out about 15% of the total value of the company, with the PIPE being another portion, roughly 10-11%, whatever it is, which is going to be the non-retail investors who are getting a preferential deal at the same time as the SPAC concludes. But also we're going to be having the Arab investors and the other people who, Saudi Arabia is one of the biggest investors in the company. They're going to be holding the vast majority of the stock when the company goes public. It's going to be quite interesting because in September, the people who are buying through PIPE are going to be able to sell their shares. So there's basically three types of shareholder with Lucid, with CCIV. So there are the previous shareholders, predominantly Saudi Arabia. There is the PIPE, which is the institutional investors, so like big companies that get approached for funding, and they're investing money at a fixed rate of $15 at the same time as retail investors are buying them at whatever it is, $22.80. Their share price is fixed, it doesn't move because they got in earlier and they agreed it, and that's quite a common approach. But they have a clause which means that they can sell their stocks at the end of September. And we're now sort of middle of June, approaching July. And September might come sooner than we might think. And the problem is some of these companies are maybe not in it for the 10-year or longer hold with CCIV. And so with those investors, when they know that they can go and sometime in Q3, people are saying end of July potentially, go and acquire these shares for $15. And then only 2 months later, sell them. Let's say they're the same price as they are today, for $23. We're talking a 50% gain. Materialize today, in September, they can go and sell them and make that gain. So that's going to be quite an interesting question mark as to will that drive the share price further down. But people have been saying that the recent downward trend, so there was sort of a speculative ramp up that Lucid was having, and it's sort of begun going down since then. But we'll see how that actually plays out. That'll be quite an interesting one to watch. The other tech stocks are sort of trending down as well. In this portfolio I've been talking about more recently, I'm not having a good day. The only one is Micron that is doing okay, but actually overall it's one of my weakest performers. But I don't have very much green today. And in fact, at $605, I'm still quite keen on Tesla, because this is actually going to, on this particular portfolio price down, I bought most of it at lower than that on other portfolios. But if for anyone who hasn't been watching my recent videos, I've opened up an account with Stake recently. So I have my Trading 212 portfolio. Actually, I have 4, because you're allowed more. You can have your ISA, you can have your main investing portfolio, your spouse can have a portfolio, blah blah. Anyway, but I also now have this Stake one. And I really like Stake. They don't offer ISAs, which is a big downside, and they only allow you to invest in US companies, and they charge you the fee to deposit and withdraw. But if you're frequently buying in and out of companies, they're now cheaper than Trading 212 because they don't have any transaction related fees. The fees only when you deposit and withdraw money. If you're interested to check them out, make sure you use my link in the description below and you get a free share. That's a plug there. The free shares are quite good, actually. They're better than with the other ones. The minimum you get is GoPro, and GoPro is $12.31. That's not bad. That's the lowest share that you can get if you go and sign up. You have to deposit $50 or pounds, £50 I think it is, to go and get that free share. But anyway, Anyway, so I signed up, and I didn't really know much about them. I didn't have that much in the way of expectations, but I really like what they're doing here because it's sort of like very Robinhood-esque. We're not allowed to use Robinhood in the UK, but it looks and feels in some ways very similar. Like this chart here, all of this stuff looks very, very similar. I quite like it. Anyway, so we need to go and buy some shares of Tesla. It might continue dropping. It might, but it might not. And at 605, I'm quite happy. So I'm 604. All right, let's go and buy. What should we? Should we just buy a share of Tesla? Ugh. 1 second. Let me just buy a share of Tesla. I want to buy something. Let's see if we can get 50. All right. Review. Buy. Anyway. Let's go back to looking at some of the curves. We'll come back to see if this actually happens. Right. Palantir is another interesting one. They had this giant ramp up recently over here, and are now back down at sort of $25. I was buying them heavily when they were below 19, and it's quite a weird one. It's one of those. There should be a word for it. I mean, I think I referenced it before. The price is still really good for me relative. By the way, this is just my personal opinion. You need to go and do your own research. Make sure you go and check all these things out and do your own numbers. But for me, my target price is still significantly above it. But you have this kind of like, it's like the opposite of fear of missing out. It's like you're in, but you wish you could continue being in at the price it was like a month ago rather than the price it is now, even though the price now is still cheap. It's like when you go to the supermarket and the beers are on 25% off instead of buy one, get one free. And you're like, oh, I should have bought twice as much last time. Anyway, it's that kind of feeling. I'm not sure as to what it's going to be doing over the next few months. It's probably going to be trading sideways largely because people know what they're expecting, and they're expecting huge results when Q2 comes out because there's been some massive news coming out about new contracts and all that kind of stuff. But I'm kind of probably going to be leaving that one alone just for now. The other one that I hold some stake in is Fiverr, and Fiverr's not been doing too well. So I've got like, what is it? So you can see the share price kind of fell, and it's been doing well. So Fiverr is an interesting one. In my portfolio on stake, I actually have two different companies, which are sort of like the proponents of the gig economy. Because I think for the next decade or so, these companies are going to be absolutely killing it, because the way that we shop, the way that we interact, the way businesses actually hire people, so instead of like recruiting people, they can go and outsource jobs. All of this is changing at an incredibly rapid pace. And companies like Etsy and companies like Fiverr are massive enablers of this kind of stuff, and they are extremely well positioned to benefit from it. I know there are others, and the beauty of this market is it doesn't have to come at the expense of others, because the market is growing so rapidly and will continue growing so rapidly. That's why I'm particularly keen on it. But anyway, so these two have dropped a little bit, and Etsy is still down. On Etsy, my target is very bullish. And so Etsy here, should we go and buy a share of Etsy? Did we end up buying? We'll check in a second. Let's go and buy a share of Etsy. What are we trading on? 164. Let's buy it. Let's just try to get a tiny discount. Anyway, what do we get? Do we get Tesla? Do we buy that Tesla? Still pending. Okay, still pending. So hopefully they'll go through in just a moment as we're fluctuating over here. Let's have a look on here. What is Tesla doing? Yeah. We might get it. We might not. Anyway, so CCIV. Somebody's asking, would I still go in on CCIV? And this is quite an interesting one because, let's look at it on here. CCIV has had a lot of negative press recently, and that's partly why the share price kind of like the positivity around it when it collapsed. So the news that was emanating in April and through to May about the fact that they potentially misled some investors because they said that they're going to ramp up production quickly through the end of this year and they're going to be making like thousands of cars, 6,000 cars this year. And then they said, okay, well, we're not going to be making 6,000 cars. Hopefully we're going to make 600 cars. And these are the pre-ordered ones, largely for the initial early investors. So the public will probably not really even see any of those 600 cars. And they're now saying that there's potential issues with, like ramping up to the 22,000 volume in time for 2023, and people are not taking it very kindly. The truth is, Tesla, when they were ramping up their production of Model S, was suffering from exactly the same thing. And these guys are already far further down. So if you heard recently, there's been a lot of interesting news with Lordstown Motors. They've really screwed up. Their CEO and CFO have left because the company has said that they are the only two people in the company who managed to cook the numbers on what their pre-order numbers looked like, because nobody else in the company knew, and they definitely didn't actually use any of the analysts or any of the other people working to create those numbers. Their share price is tanking, and it, rightly so, because the company is basically built on hype. It's a bit like Nikola. I made a video some time ago about Nikola, about a company that is basically entirely based on hype, does not have any way to manufacture anything, has not really hired people to do the manufacturing, does not have the facility, does not have the technology, does not have the insider knowledge. But yet people are investing in these companies, are valued in the billions. I just get astonished when these kind of things happen. These guys are sort of the opposite of that, where they're suffering from the pain of setting up the factory. You can go and watch, there's endless videos on there. They have a YouTube channel of all the stuff they're doing in the factory, and like they show the live production rails. But it is incredibly difficult in the modern, highly complex kind of tech age to go and make an entire car manufacturing plant from scratch, which produces these new EV cars. Is just an incredibly difficult exercise that took even Tesla a considerable amount of time. So I'm okay with the delay. The issue here is that this sort of continues being a long-term play for me, and I'm not really particularly excited about potentially what's going to be happening over the next year with CCIV. In fact, I see the stock potentially dropping because the only real positive news that's going to be coming out of their situation is going to be please change the graph. Sorry, what graph should we look at? Should we look at Tesla? Oh man, that's not good either. Well, seeing as we're talking about a tech downturn, let's look at the graph here. Has Tesla? Oh, Tesla going down to 604.50, which is what we're buying at. Anyway, so CCIV is now in a situation where the only positive news that's going to be coming out is not really material in any way. It's when the ticker changes. So they're saying end of July is going to change from LCID, is going to change to CCIV to LCID over on the New York Stock Exchange, and that's it. Then through to the end of the year, there's not really going to be any positivity. There's going to be some like press, and they're going to be showing the first cars rolling off, hopefully, and some people taking delivery, maybe, but nobody will actually see them in public other than the ones driving around the San Francisco Bay Area, because their factory is just north of the Bay, and then they cross the bridge and they do circles around Palo Alto, etc. It's quite interesting. There's a lot of people seeing these guys. They have about 100 cars at the moment that they're like driving around and testing, and they keep manufacturing semi-manually some more cars to go and test new things out. Anyway, so we're not going to be seeing any positive news probably until Q2, Q3 next year at the earliest. And as a result, there's not going to be anything interesting for like almost a year probably with this stock. And so for me, this is very much a long-term play. Some people are not happy for a stock where there isn't really any at all, probably potential upside, other than maybe hype, or just people getting very excited when they take a change, or something else. But there isn't like Q3, Q4 results potentially driving the price, because they're not going to be showing anything. They're not going to be showing any numbers that are going to be in any way material. So unless you're really excited about the long-term holding for like several years, you probably aren't quite as keen on holding CCIV for that reason. Anyway, let's talk about Tesla. Somebody's asking, James is asking, has my target price for Tesla changed since the valuation video? I haven't actually redone it fully because the changes so far have not really been material. My evaluation was based on a 10-year outlook, and I actually had some things in that video that I baked in that are now materializing strangely. So I was saying that I expect at least one for sure, possibly both of the Berlin and the Austin factories to be delayed. So I think I had like one of the factories starting with a very small production run in Q4 this year, which was more pessimistic than what Tesla was saying. And I can't remember, I think it was the Austin factory that I said was going to be maybe Q1, Q2 next year. It may be even slower than that, but I think I never anticipated the fast build-up of those anyway. Some of the China news is probably that is reducing the production there is probably not as good as what I expected, but the energy side, because they're now ramping up the battery production facility over in Nevada and they're applying for the extra facility to produce batteries over in Berlin, I think that might ramp up that side of the business a lot more than potentially expected at this stage. So it's going to be, you know, every quarter there's going to be ups and downs. I actually expect that Q2 will probably not be too kind to Tesla, but in the grand scheme of things, when I'm basing the majority of my valuation, despite the depreciation, is really coming from probably 2023, 2024, 2025 numbers, and then the sort of the forward outlook from that. Even if inflation jumps, you know, even if it's going to go to 5% or even 10% at some point later this year, as some people are saying maybe it will, we're still only 2 or 3 years away from those numbers, and so the depreciation on what I think will be colossal jumps is still not going to be, I think, material enough. And I think as with anything, inflation can go up, it can go down, it can stay flat. Like people always talk about it jumping, but it doesn't, I think, materially impact anything anyway. For me, anyway. Did we buy some Tesla? No, not yet. Well, how come? I thought the price was going down. I thought, did we not get it? Damn it. Who did that? If somebody bought Tesla instead to make the price go up, I'm not happy. I should have just bought it. I just wanted to buy one whole share just for no reason whatsoever. I was a bit greedy. Anyway, I'm sure it will yo-yo back down at some point. If you look at my portfolio over here on stake that I was discussing the other day in one of my videos, some of the other interesting plays I have here are more tech-based. So I have TWLO over here, down 2%, still doing pretty well since I bought it. Adobe and AMD, again, they're all doing quite well. I probably should expand a little bit more on this, and I was thinking whether I should do this in this video, but I'm going to save it. I'm going to save it for maybe tomorrow or the day after, when I'm going to be sharing some new valuations of companies that I'm particularly excited by, that I'm going to be explaining why I'm particularly interested in buying them. So I'm going to go into the depths of that at that point. One point that I'm going to make about this portfolio, I think is important, is I am not a guy who generally does trading. I don't like try to go and artificially bump up, you know, like the prices, or try to catch the wave, or try to look at the fundamental. I mean, like, I did trading. I actually worked in trading for like almost a year. But I'm not that kind of guy. I don't really enjoy trying to figure out what the candlesticks are doing and trends and blah, blah, where is the support line? That's not me. But with this portfolio, I'm going to have to do a bit of that, because just buying and holding and just sitting on it is basically just trying to pick a subset of the overall, like, you know, VTI index or S&P 500 or whatever it is that you will, and hoping that your subset outperforms the overall. But you kind of limiting yourself, because the whole objective of the series that I'm doing, Man versus the Market, is to try to beat the market. I'm going to have to try to sell some stocks as they go up, and I maybe should have done that with CCIV when they pumped way beyond, because of what I was explaining just now, where I think that the material impact on price is not going to be happening for some time. I think next time the price goes and does, because CCIV do these jumps. It kind of looked like they had this ridiculous jump when the news was emanating about them, the merger, and people were getting very excited. And then we kind of like saw like bang, another jump up to over $30. Sort of sitting over here, then jump up, then a long sit, and now we're jumping up again. And I expect that we're probably going to be seeing a lot of this. A lot of sort of like up and down, because materially nothing much will change. But potentially what I'm going to have to do at some point is, next time the price goes and approaches that $25 to $30 mark and begins doing something in that space, maybe I'm going to have to go and sell. Not because I actually, in my other portfolios, I'm not going to be doing that. I'm going to be keeping them long term. But just because I'm trying to play this exercise of how much can you beat the market, and can you? And you can notice here I've got these Fiverr is up 18%, Palantir is up 34%. Although with Palantir, I don't think the same is going to be happening. With Palantir, I think we're going to be seeing quarter after quarter of ridiculous numbers. So I didn't expect them to be up a third since I bought them a month ago. But anyway, that's just me. Ben is saying, Sasha, I'm a degenerate with AMC gains. Can you do a video on trading 212 CFD so I can attempt to short it later? I was planning to do. It's kind of weird. I had it on my to-do list. But it's kind of difficult because I myself don't play CFDs. I did some CFDs recently on my eToro account before I did the review to test if they were going to be doing things that I think they should be doing or not. Because some people said that they don't, that they sell out of your position early, etc. So I actually went and lost some money in order to test some of these things. None of them actually came through, so I didn't talk about them but anyway, so I don't really play CFDs other than for reviews or whatever. But a lot of people probably want to understand how they actually work. What are they really? And I know that in the UK in particular, we maybe aren't quite as, actually it's the same in the US. A lot of the content that you see online is probably not quite accurate enough, or maybe not good enough at actually explaining the intricacies of exactly what they do, how they work, and some of the risks and things to look out for, and things that maybe people are not aware of, with like the moment when your position gets closed and what that really means. So I probably should go and explain it just so that people can understand it better, even if I don't think that it's actually something that most people should do, especially if you're a new investor or an inexperienced investor, or certainly if you're not a very active investor where you are able to dedicate a lot of your time during working days to go and play them, because there are massive issues. Anyway, AMC, a few people are asking about AMC. I'm noticing. I had a live hangout with Tom Nash recently where we covered this. I don't think the live video actually stayed up because most of his live videos he doesn't keep up, or maybe keeps up for a day, so it's not there anymore. But we were talking about this because if you follow him, he's like a big US YouTuber. He has 200,000 plus subscribers, 215 or 20,000 subscribers. And he has been talking about AMC a huge amount, and everyone else as well. Pretty much every big financial YouTuber has been jumping on the bandwagon, talking about it. And I haven't. And I haven't for two reasons. One is I myself am not playing. But two, I actually don't have the sort of interest. Because the problem it's sort of, if you're a ground level investor, you might not know much about it. You might be kind of scared off. And then you have this people who, maybe know quite a bit. People who have invested for some time, people who know how to do their research, people who understand how short squeezes work, people who understand what it means to short and like what that really means for hedge funds in terms of when their shorts are going to be called, and what that means in terms of potentially some of the implications of that. But the problem is, in my mind, I love the Wall Street Bets kind of saga. I'm really interested in it. I pay attention because it's just out of curiosity and interest. But the problem for me is that the people who are in that club think that they are much higher in the sort of like order of information and knowledge and ability than potentially the average person in that group is. And although they know a lot, and although the fact of the matter is you're playing a quite uneven game. And let me explain what I mean by that. So people kind of talk about the naked shorting. People talk about the repeat shorting, which, by the way, is going to be made illegal soon. So naked shorting is a strategy where you as a company go and short a stock. So you're basically borrowing somebody's stock. You then sell it on the market, and you're promising to the person you borrowed it, you're going to go and give them the stock back at some point in the future. And you're hoping that at that point in the future, the stock is going to be cheaper. So you're going to be buying it back at a cheaper price, giving it back. And you've made the difference between when you sold it the first time and when you bought it back at a lower price. Now, naked shorting is a practice when hedge funds or some other people have the capacity to be able to sell that share without actually owning it, without even having borrowed it. And there are two ways in which this happens. There's one which is the sort of legal way, which is technically if you're a hedge fund or a certain particular approved types of entities that trade directly with DTCC, you can go and sell some of these shares without owning them if you can demonstrate that over time you always know that you could borrow them if you need to. If you hold that short position for over 3 days, you will have to go and get them in those circumstances. And usually people go and like figure out when during that period they need to actually go and acquire. And it's dirty. If you close within 3 days, a lot of times people don't even actually ever end up borrowing the share. So there is a sort of semi-legal way in which this happens, but there's been a lot of recent news where there's been this illegal practice of actively short. So people shorting AMC, for example, without actually having borrowed the stocks or having any implication or having any want to ever borrow these stocks. And this is kind of weird because a lot of the numbers that are coming out are suggesting that this is actually the case with AMC in particular at the moment. They're suggesting it could have been the case with GME, because we're seeing situations where, you know, over 100% of a stock can be shorted at any one time. So what that means is I go without, if you ignore the shorts, the naked short selling, I go and borrow a stock. I then go and sell it on the market. The person I sold it to then maybe sells it to somebody else, and it moves around, and it ends up with the same person that I borrowed the first share from. And they go and lend it to me again. So essentially I can go and borrow the same share over and over, go and sell it, and that's how you can short over 100% of a company's stock. The problem is that the unwinding of that can happen in a lot of different ways. And I think this is my kind of personal view from somebody who works in the industry, somebody who's like actively worked in trading before, somebody just like curious, has a curiosity about the topic, where I do a lot more potentially research than maybe some other people do. They can unwind these in more ways than just buying shares on the market, which is what Wall Street bet kind of guys rely on essentially, and what the whole short squeeze relies on, because they're basically saying that, you know, eventually these guys who are shorted will have to come back and buy the shares. Like, in a very, I'm simplifying this a lot, right? And when they come and buy those shares, if enough of us hold the shares, then the price is going to continue rising because they have to buy so many to close out all their short positions. And like, let me give you a super simple example, because there's several different ways that are a bit more complex, involving instruments and involving, you know, like delaying that to far beyond where the Wall Street bets, I think, will be happy to play their game. But aside from all of that, if I have done this circle of shorting the same share, the same thing can be done to unwind with buying them back as well. And this is, I think, the point that people are missing out very often, which is, if I need to go and pay back this guy that I just borrowed 2 shares from when actually it was the same share, I can go and buy a share from somebody, go and give it back to this person, and then that person, because they don't want to keep holding the share, get rid of it, it goes, cycles back in the market, I can go and buy it again. And the problem is, the same way that these guys go and ramp up the short positions through cycling the same shares in a very simplistic way, and it doesn't quite work in this way, but you can unwind them without having to go and buy the 100% or close to 100% of all the available shares, because they can unwind them in the same way without touching the majority of the market. And I think like the dynamics of how this happens are something that is sort of being ignored by this hype that is built up around this AMC stuff. But anyway, I personally don't play short-term trading. As I said, I'm very interested in some of the stuff that's going on in that space, but it looks like I'm not going to be buying my Tesla for my low price. Did I buy anything? I need to buy some shares. So Tesla will still have. Oh, we did buy. We executed. Nice. So we are proud owners of a whole Tesla share at a low price of 604.50. So that went through. And what else was I buying? I can't remember now. Was it Fiverr? Did we buy? Yeah. I can't see it. I can't remember what I bought. Anyway, let's look at some of the other companies that I'm particularly excited by and interested by. One of them that has not been having a lot of attention on it. Where is it? AMD. Let me talk a bit about AMD. AMD is down to $81. And the interesting thing, the reason I'm kind of excited by this is the scale is good here. Like, AMD has been at this price back in like August, July last year, which is what I was buying a lot of it at that price. And back then I thought it was low. But now we're seeing like the same, it's kind of yo-yoing up and down. It was very, very cheap over here. I bought a little bit over there. And to me, this price is still very low. So there's several different things that are happening that I think are playing. I probably should do a whole big valuation model thing for AMD. I'm going to be doing that at some point very soon. I'm going to be talking through why I'm particularly excited. But to take a step back from the actual numbers, we have a company that is absolutely dominating in process and manufacturing on the retail side space, which is incredibly powerful. And it's powerful not just in, like people like me going and buying and process to shove in our computer, but it's just the gig economy that I was talking about, the people working remotely, the higher processing power work flows increasing, everything from video to just high-end modeling to various different mathematical applications that people are using in engineering. There's a lot of reasons now why people are professionally requiring this processing power, and these guys are just killing it on that front. They are catching up very, very fast with NVIDIA on the graphics side. So they were nowhere to be seen 2 years ago. They sort of entered with their first generation thing a year and a half ago. Last year, they got close with their latest series of graphics cards. And people are saying that when it comes to Q4, when they typically go and release into the shops just before Christmas, the new gen, that they're going to be probably on par with NVIDIA, potentially maybe there or thereabouts, maybe even doing slightly better. It's a maybe. But there's some other stuff that is really huge. So AMD are producing the chips for a lot of car manufacturers, for some console manufacturers indirectly, for a bunch of different people buying them up. You'll notice that Tesla, the new Tesla they're releasing with a big screen that allows you to play Cyberpunk and whatever else. That Tesla is running on AMD chips. They are absolutely dominating that space. And not just that, oh, look, I've got a cat here. They're not only just dominating that direct kind of partnership mode, but they're also now beginning to sell chips that are going into giant cloud data warehouse solutions. Hello. And those chips are doing incredibly well. Those chips are, I think that side of the business is growing at several 100% year on year at the moment, which is an incredible rate of return. And so if that continues, I can see some really spectacular numbers coming through when we're going to be getting the next few quarterly updates. These guys are just killing it in their space. And I think that a company like that just is moving so much up in every single metric that I can talk about, really, is continuing to be down. I'm going to be buying a bit more. Should we buy a bit more on stake? Let's go and have a look. Where are they? AMD. I bought some last time. Let's just buy market. I don't really want to see if it completes or not. Let's just buy it. How many shares should we buy? Let's go 4. Oh, oops. I think I need to put in a quantity. Let's buy 350. That'll do. All right. I quite like this. This platform is kind of basic in some ways, but it's just so clean and nice. It's like, it kind of like makes me think more like an investor rather than a trader with all the, like you open trading 212, look, you open trading 212 and it goes bang, like graphs and everything, and it's different themes, and you have like all of this stuff going on. And like it's nice. It has far more data and far better information than any of the other platforms that are available in the UK by a country mile. I'm sorry if you don't have an account. I know it's been 5 months and nobody can create a new account, but they're doing pretty well. But you look at stake and it's just like minimalist and clean, and it's like I can kind of take a step back from all the candlesticks and the things. It's like when you open an eToro. If you have an eToro account, by the way, you can go and check them out if you want. Use my link in the description below to get absolutely no free shares whatsoever, no benefit. I get a small commission if you go and use my link, but if you do want to check them out, I'd be grateful. But if you go and open one, if you go and open eToro, it's just like red and green and it's flashing at you. And it's like, you need to buy now, you need to buy now. And what it'll do is, eToro suffers from that problem that your mate that maybe sits across from you at your workplace suffers, where, when you come back on a Monday after a weekend and that person's been gambling, they'll tell you about the wins, but they never tell you about all the money that they're losing. So it kind of sounds like they're always doing really well with all their betting. So it's like, oh man, I placed a tenner on that football game and I won. So you totally do the same thing when you get these notifications saying your portfolio went up 2.76% yesterday. You should deposit more. It never tells you that your portfolio went down 10% yesterday for some reason. Anyway, I find that funny. So, but yeah, so what do we got? We've got $564 to go and put into something. Probably buy some more stuff at some point. What are people saying? What are people saying? Why would someone be bearish on AMD? That's a good question. I'm not seeing the signs. As a long-term investor, but again, people are playing different kind of games. If anyone has any questions, because I'm just scouring to see if anyone has any questions. I did say in the description, if anyone has any questions, let's have them. Let's discuss, debate stuff. Let's see if anyone has any other interesting things over here. What's the best? This is an interesting one. Hi, what's the best way to track all my investments, crypto and stocks? This is a really good question because I've been analyzing and looking through a bunch of different options available and different tools that are available. And I just think all of them are either pretty basic or don't really do what I think they should be doing. I'm just not a big fan. And so I'm kind of thinking, like, why isn't there a really good thing that directly integrates with these various, imagine if you had a tool that goes and integrates with all the various trading platforms. It doesn't try to replace them, but just a central place where you can go and manage this stuff. Something which will show you what your actual gains and losses are, etc., and what the overall sum of your portfolio looks like. And maybe something that will then be able to calculate capital gains on your non-ISA accounts as well, so that you don't have to actually figure out how to separately do that and manually do it in an Excel spreadsheet. I think there should be something like that. I'm kind of half tempted to go and spend some time building one of them, but it's going to take quite a while. So I'm not sure if I'm actually that tempted. But there's definitely something. If somebody knows of a particularly good tool that I haven't found yet, please do shout, because all the sort of like ones that people suggested before, I went and looked at them and I was like, wow, it's just nowhere near good enough. Root or Crisp, people are asking specific stocks. I need to be kind of careful. Like, so which one's better? It really depends on a million miles. I actually don't hold a position in either at the moment. I think in any of my portfolios. I used to have some, but not much. Anyway, let's quickly go and talk about what's happening in the market overall, because that is an interesting thing that kind of doesn't get enough attention. So if we go and look at the total market index, for example, no, wrong one. The trading 202 doesn't have VTI. Let's look at VUSA, just S&P 500. They'll do for now. Can't remember the tickers. So we're seeing. So the reason I want to bring this up is we're seeing something that is actually remarkably similar to what I was talking about earlier in the year, which is there's been a tech sell-off. But if you haven't been in a tech game, you probably don't know that anything's happened. So there's only been this kind of rise in the last month. Let's expand this to like an hour or something. So there's been this kind of rise in the month. So roughly at this position, I was investing my tech stocks on that portfolio I was showing you on stake, and roughly here is where we're at the moment. And the price hasn't really been doing very much, right? Like on the overall market perspective. From we've gone from like 55 something to low 57, so like a bit of movement, but not the kind of crazy movement that we've been seeing in some of the tech stocks. And more recently there's been like very little movement over the last month, almost coming up to a month, sort of like trading sideways with the market. But those who have tech stocks are seeing some of them really go and begin jumping up. Some of them are dropping down. And it's interesting because we were seeing the same thing earlier in the year. I should probably go and change this to like 4 hours on one day or something, where the tech sell-off was happening, and some companies like Tesla, big contributors to the overall total of the S&P 500, were losing a huge amount of money. When they jumped to over 900, then dropped to $600. But the overall market kind of ignored that completely, and that's quite an interesting one. So the real proof here is that overall investing in the market is going to be good for 99.9% of people, and idiots like me think that they know better, and we talk about stocks and stuff like that, but in the end will usually lose out. And anyone else investing specifically in stocks that they pick themselves, on average, will lose out. We'll all think that we're in that 1% or 0.1% or however many you actually think of retail investors beat the market. And there are some good reasons to believe that you can beat them. I actually have a video, I think, when I talked about that. Like, there are some good reasons why a retail investor can beat the market better than potentially an institutional investor, because institutional investors are, even if they're an actively managed fund, they're bound by a bunch of regulations on how they have to distribute, the timings of their trades, the ability to try to game on trades intraday, etc., like when they have to close positions, like what they have to close versus their forecast. So if their forecast says the company is going to be doing X and Y and Z in the next several months, they have to go and close because regulation, SEC, etc. And you as a retail investor, you're not bound by any of those things. But there's a few other reasons as well. But those guys, like I showed some numbers in a recent video where like 85%, 90% of actively managed funds with thousands of analysts, supercomputers, all of that lose versus the market. So think about what you can do when you're not 100% in it. You're not spending hours, thousands of employees worth of hours time analyzing all these things. So it's one of those where, like, we like to play the fun and games, but if anyone's new to investing, if you're not quite sure, if you don't want to be picking stocks, if you don't feel like you have the time to be doing your analysis, you're almost certainly better not doing what I'm doing over here. So make sure you don't do what I'm doing. Don't do this at home. Do your own research, etc. Blah blah blah. Oh, we have a channel member. I have, by the way, a channel membership for anyone who wants to join in. It's a very, very small club of people. Look, we have somebody, Ostrex here, been channel member for 2 months. Big up. Sasha, I have FREETRADE and eToro account and buy individual stocks on each one. I won't be investing more than 10,000 in this financial year. So will it be okay using both without paying capital gains? This is a very good question. So FREETRADE offer the general investing account, which is free, but you have to pay £3 a month for the ISA account. So if you're investing smaller amounts, it can be quite expensive. eToro don't do an ISA account at all. And obviously with Trading212 closed, and Stake not offering ISA either, there aren't that many good ISA accounts. So Vanguard is probably the next best one because they're only charging 0.15%, which is cheaper than FREETRADE for most people with smaller amounts of money. But you can only invest in Vanguard funds and ETFs, and not even all of them. For example, you can't invest in VWAG on Vanguard, but you can invest on Trading212, for example. So yeah, if I was in that position, I would say, unless you're expecting some ridiculous gains, because you don't pay any capital gains for £12,300 and under in gains, you'd probably be all right. And the beauty is, if say Trading212 opens, or Robinhood turns up, or Webull turns up, or M1 Finance turns up with a free ISA or something really, really great, you're always able to, at that point, go and take your gains, as long as they're under £12,300 for the year, and go and shove that money over into the ISA, and you're not going to have to be paying any tax whatsoever. So that's a benefit there. And anyone else, like, we talk a lot about ISAs, but for anyone investing relatively small amounts of money, it doesn't really matter, because you don't pay dividend tax for under £2,000 worth of dividends per year, and you don't pay capital gains either. So, it doesn't really matter. You don't need to pay for the privilege of using an ISA, because you're probably not going to be getting into tax. And if you get close, if some of your investments grow so much that you might be paying tax, you can go and close out those investments at that point in time before you cross the threshold, and then go and decide to go and move into an ISA. And then you can make a more informed decision later down the line without having to pay any money in the meantime. You will have to pay the fee, so you got to be a little bit careful, because a lot of these people have foreign exchange fees and some other fees, or withdrawal deposit fees. So make sure you're aware that if that was to happen, you're going to have to pay some of those fees that will impact the total invested amount. But it's not a big deal. Anyway, I'm going to have to go, guys. I have to go and jump on something else in 2 minutes' time. I really appreciate everyone joining. Thank you so much. Thank you so much to everyone joining in and all the questions. Really, really appreciate it. And I will hopefully see you guys tomorrow.